Welcome to Wealth. I'm Madison Mills, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to know to grow your money. On today's show, it's a portfolio checkup. We'll discuss why now could be a good time for investors to revisit their risk tolerance amid market volatility. We'll also check in with Yahoo Finance senior columnist Kerry Hannon about 4 ways to protect your retirement nest egg amid heightened political and economic turmoil. And tariff takeover. We will dive into how President Trump's tariffs on imports from Canada and Mexico could impact the price you pay for a new car or home. But first, let's take a look at some of the market action 90 minutes into the trading day. Stocks fluctuating amid ongoing tariff concerns. You've got the Dow actually recovering to the upside, the NASDAQ moving back to the downside. You've also got your S&P 500 down about 0.1%. The market digesting commentary about the implementation of tariff policy, but also that weaker than expected ADP number showing that jobs grew at a slower clip than anticipated. We will, of course, get clarity on the labor market as we get that key non-farm payrolls print on Friday. Joining me now, we've got Matt Stuckey, Northwestern Mutual Wealth Management Chief Portfolio Manager of Equities. And Matt, you say that all this volatility, it's a good opportunity for investors to revisit their allocation and also rethink their risk tolerance. Explain to me how you're looking at allocations right now.
Well, good morning. Thanks for having me, Madison. I think this volatility shakeup is somewhat of a wake-up call to investors. For the last couple of years, we've seen stocks move up and to the right, and that's just not how they behave on a permanent basis. There is volatility associated with equities, and a good portfolio does have components to it that help to insulate the portfolio against this volatility. So think high quality fixed income or real assets. And so, this is a good opportunity for investors to take a look at their portfolio and make sure that it aligns with their risk tolerance and that volatility is not going to cause them to do something painful or harmful to kind of their long-term wealth if they can't handle this on a go-forward basis.
I think given that so much of the double-digit gains that we've experienced for the past 2 years have been in a large part due to the lift in tech stocks, we've seen a lot of younger people in particular shifting a lot of their portfolio allocation to those large cap big tech names. Should younger people who have a little bit more timeline ahead be rethinking allocation to big tech in this environment?
Look, I think no matter kind of what type of investor that you are, technology is going to be a big component of your portfolio. It's such a huge component of the S&P 500, which is the index that a lot of investors gravitate towards here in the United States. However, there are other places to invest besides just technology, and kind of when specific headwinds or tailwinds to technology kind of cause outsized influence to the upside or to the downside. And here specifically, we can talk about artificial intelligence investing. Mm-hmm. We've had that be a huge tailwind to technology the last couple of years, but so far this year, it just hasn't really been that. And if you're overly concentrated towards U.S. technology, you miss, some of the rotation that's happened within markets, specifically, international equities, having a good start to this year, which wasn't, the base case for a lot of investors as we started 2025.
So it sounds like this moment is a reminder that it might be good to own the index, to invest in ETFs that are tracking the broader S&P 500 as opposed to maybe allocating too much capital into one sector versus another?
I think that's correct. I think if you look at kind of long-term returns in a portfolio, what you get paid for doing is by kind of diversifying of risk in a portfolio. You don't necessarily get compensated well in terms of owning a lot of what's called idiosyncratic risk or stock-specific risk. We invest in individual equities as well, but that's well diversified across the portfolio. Yeah. If it's concentrated risk that we're talking about as it relates to technology, that can have outsized impact to the downside as well as to the upside as it relates to a portfolio. It's just sometimes a lot of investors tend to overestimate their tolerance for that level of concentration, and find out after the fact when it moves against them that they just didn't have that risk tolerance going into the trade.
And what about investors nearing retirement? If they are concerned about the next couple of years, more volatility under the Trump administration, should they reposition?
Well, I think if you are an investor that is nearing retirement, talk with your financial advisor, come up with a portfolio that makes sense for you. There are other investment alternatives besides just tech stocks or overall equities specifically, I think high quality fixed income still remains an attractive place to invest, and it's shining through this year as you look at kind of what's done well so far this year amidst all the volatility. It's been high quality fixed income that's put up really solid returns on a year-to-date basis, and despite the tariff narrative that's out there and the policy uncertainty surrounding tariffs, we've actually seen nominal rates move lower, which is pushed total returns from a fixed income perspective higher, creating somewhat of an offset to the volatility that we're seeing on the equity side.
And I really quickly want to end with a specific stock that you like for us. You talk about ICE. What do you like about them?
Well, ICE is an interesting stock in this environment. Higher volatility is a tailwind to their business. They operate the New York Stock Exchange, and higher volatility in the markets translates to higher trading volumes for their market business. And then outside of that, you do have a recurring high margin business in the form of selling market data out to professional investors, as well as the potential that if these tariffs cause growth to move lower, and with lower growth comes lower rates, that's actually somewhat of a cyclical tailwind to the mortgage side of their business that has been under pressure from higher rates causing a lower level of activity in the housing markets. And so if that were to change, you get the cyclical upside in the mortgage business, which is continuing to grow despite the depressed levels of activity that we're seeing in the housing market today.
All right, Matt, we got to leave it there. Thanks so much for joining us. We appreciate it. It's time now for some of today's trending tickers. Scan the QR code below where you can track the best and worst performing stocks of the day with Yahoo Finance's trending tickers page. First up, Novo Nordisk shipping its weight loss drug Wegovy to cash-paying patients at a reduced price of $499 per month. That's down from over $1,300 a month, more than $850 in savings for those consumers. Now, this is for uninsured patients or eligible patients without coverage for obesity meds specifically. This direct-to-patient model, it's growing in popularity amid the shortage of weight loss drugs that had patients turning to cheaper versions sold by telehealth companies the likes of Hims and Hers. That stock is down today. Eli Lilly also lowering the price of its Zepbound vials last month, and that stock also rallying off of that news. Next, Apple is unveiling new laptops, desktops, and iPads. The new MacBook Air will get the company's M4 chip and will actually cost $100 less than it did before. Apple's Mac Studio desktop is getting more horsepower with its M4 Max and M3 Ultra processors. The higher-end model will run you nearly $4,000 at $3,999. All the computers will have Apple Intelligence, the iPhone maker's Gen AI platform, and there's also a new iPad Air with the M3 chip and a new Magic Keyboard and with more storage on that MacBook as well. Now, the move should help boost Apple's iPad revenue that fell 6% in 2024 from the prior year. And finally, Palantir getting an upgrade at William Blair to market perform from underperform. Analyst Louis DePalma touting the company's government contract, saying despite risk of a 40% plus drop on potential delays, these government deals have been stickier than envisioned, and a batch of deals made in the fourth quarter could bode well for first quarter revenue growth. The analyst also noting the company's AI pipeline could support the stock's value moving forward. You see those shares up just about 0.6%. Now, the major average is off to a rocky start for the year, and with more market uncertainty following the implementation of the president's tariffs, Yahoo Finance's own Kerry Hannon is here to share some ways to protect your retirement nest egg. Kerry, always a pleasure to speak with you. Talk to me about what retirement savers nearing retirement can do to protect their retirement accounts.
Absolutely. Thanks for having me on. Volatility is often just noise, right? So it's really important to keep a disciplined, long-range outlook on how, no matter if you're nearing retirement, because you may have 30 years in retirement. So the first thing, number one, I tell people and all the advisors I've spoken to today, say, wait, sit on your hands a little bit. Wait before you make any big emotional moves, okay? Number two, it's important to stay in equities, no matter how close you are to retirement, because you need to stay invested here. This is where your growth is going to continue to come from. That said, the older you are, and the closer you are to retirement, you need to shift a bit into, some cash equivalents or some great fixed income opportunities, because you want to have 5+ years of living expenses, right? We're just at the beginning of what I would anticipate to be a few years of volatility. So keep in mind as well, if you're invested in your 401k retirement plan, or if you're set up in auto investing with your IRA, you are regularly making investments when the market is low, when the market is high. This tends to even out over time. And if you're in a target date investment fund, you have managers there that are slowly readjusting and reallocating your portfolio to keep up with the risk allocation you've identified as appropriate. The final thing I would say is, please make sure you meet with your financial advisor if you have one. Sit down and talk through, is this really making you nervous? How does this volatility impact you? You might get with their advice, you might make some shifts in what your allocations are going to be between equities and fixed income. But this is someone you should bounce the ideas off of before getting too emotional. And so periodically you should be rebalancing anyway, but this might be a good time to have that conversation. The final thing I'll add here, Maddie, is that I ride horses. I jump jumps, right? That's one of the things I love to do. You know what? I don't focus on the jump. I look beyond the jump. And I think that's exactly what any retirement investor, no matter what your age, should be doing.
Kerry, no surprise, amazing advice as always. Really appreciate you joining us. Thank you so much. Now coming up, some disappointing data like today's private payroll numbers have some investors saying we're in a growth scare. We'll define that term and talk about the labor market after the break. Economic data has been disappointing over the last month. Private payrolls in the month of February slowing more than expected. New home sales hit a record low, and consumer confidence has fallen off a cliff. The slew of data making investors question whether we're currently seeing signs of a growth scare. Now, growth scare happens when investors suddenly start worrying that economic growth is slowing. This can be triggered by weak data, like slowing GDP, falling retail sales, or a weaker than expected labor market. It can also be caused by global events, like geopolitical tensions or a slowdown from a major country outside the U.S., like China. When a growth scare hits, markets react fast. Investors tend to sell riskier assets like stocks, especially in sectors tied to economic expansion, like tech and consumer stocks. At the same time, they often pile into safe havens like bonds, gold, or defensives, think utilities and healthcare. Sometimes a growth scare turns out to be just that, a scare, with the economy proving more resilient than feared. Other times it's an early warning of a real slowdown or even a recession. The key for investors is distinguishing between a temporary panic or fundamental shift in the economy. Right now, investors digesting policy from the Trump administration that could hinder growth, with the president himself saying tariffs may cause a disturbance and market leadership is shifting in a defensive direction. The big question, is the economy cooling off while the market's in wait-and-see mode, or is this something more serious brewing? Let's zero in now on the labor market. Hiring in the month of February slowing far more than economists were anticipating. Private employers adding just 77,000 jobs during the month, the smallest level of gains since July, according to payrolls processing firm ADP. The print fueling concerns of an economic slowdown as worries about growth that President Trump's tariffs could cause. Joining us now with more, Jennifer Lee, BMO Capital Markets Senior Economist and Managing Director. Jennifer, great to have you on here. What would you say is the current status of the labor market? Is it slowing or has it already hit a breaking point?
Good morning, and thank you very much for having me on. Well, I guess if you're just looking strictly at the ADP numbers and some of the employment surveys out there, or the components of different surveys, you'd say that it is slowing, and it probably is. We have already been seeing this slowing pace over the last little while, and I think we're kind of seeing it build up a little bit more now, but it's more in anticipation of what could happen. There's so much unknown out there about what will happen with tariffs, how much of an impact it's going to have on the economy, and certainly on inflation and consumer spending, and all that feeds into what consumer or businesses are going to be doing on the hiring front. I mean, all in, like broadly speaking, when you take a big step back, we're at a pretty still, up until now, healthy labor market for just over 4% jobless rate. Don't forget, we still have over 7 million vacant jobs out there. So it's still a lot of jobs to be had. So I think the labor market is still in decent shape right now. But again, things are slowing. given all this uncertainty over tariffs, what the impact is going to be on the overall economy and spending and inflation and all that. So I think businesses are probably holding off a little bit until there's some more certainty on that front. So I wouldn't be shocked if we saw a slower number as well on Friday for the payroll report.
And talk to me, Jennifer, about how that's impacting where it's easiest or hardest to find jobs. I noticed in the ADP data that there was a little bit of a leadership change, that we saw losses in hiring in areas that we typically see growth, like education and healthcare. Do you anticipate that continuing? And if so, which areas of the job market seem safe right now?
So that could be also reflective of potentially these jobs that we're seeing potential job cuts at the federal government level as well. So there could be a little bit of that being reflected. But overall, we're probably going to see at some point, you would expect more hiring in construction, for example, and continuing on in the leisure and hospitality sectors. And certainly potentially on the agricultural front, with all the greatest deportation effort ever, you're going to start seeing a lot more undocumented workers leaving the labor force, and we're going to have to start hiring for those to replace them again in those certain sectors. So we're probably going to see some of that, but I think potentially on the education front, the healthcare front is probably reflective of some of the cuts or no cuts coming in from coming in from the Department of Government Efficiency.
So Jennifer, I just want to end on your feeling on the overall economic vibe. Are we heading towards a potential recession, or is this just another continuation of the vibe session?
I think we are, broadly speaking, I'm going to say that globally we're heading toward a slowdown. We're already seeing that, just given the uncertainty. Our businesses have already started putting the brakes on business investment plans. Again, waiting to see how things fall out and whether or not they're going to stay that way. So we do not see a recession in the U.S. Per se, but it will be hit by higher prices, higher inflation. That's probably going to be the first impact of all these tariffs. We did knock down our growth forecast to just under 2% growth for the next couple of years, from over 2% growth. So that has knocked out. Still going to be growing, but other areas such as Canada, we do have a mild recession penciled in, just over 0.5% growth over the next couple of years. So for the U.S. specifically, there will be a slowdown. There already is. We're already starting to see the signs of the slowdown, but it's probably too early to say that there will be a recession.
All right, Jennifer, always great to get your insights. Thanks so much for joining us this morning. Coming up, we'll bring you the 3 biggest lessons from retail earnings this quarter, and then I'll talk to an expert about what potential tariffs could mean for your next car purchase. That's coming up next, right here on Wealth. It's report card season for the big retailers. We've gotten results from Walmart, Target, Home Depot, and more. The company's reporting amid some uncertainty about President Trump's tariff policies and falling consumer confidence. So what have we learned so far? Our very own Brooke DePalma joins us now with more takeaways from retail earnings. Brooke, what do we know?
Good morning, Maddie. Well, it's certainly been a roller coaster for retailers this past quarter. Let's break down the 3 top takeaways from earnings so far. They include consumer spending trends remain uncertain. Promotions and markdowns are still key, and tariffs are heavily in focus. Let's start with that consumer slowdown. Walmart kicked off this retail earnings season with a warning and issued a cautious profit outlook. Now the company emphasized that the consumer remains steady, but CFO John David Rainey said the team has taken, quote, a kind of prudent approach at this point, end quote, given uncertainty regarding tariffs and the overall macro environment. Now its competitor Target took that a step further. It said it saw soft sales in February, citing consumer uncertainty as a headwind in its current quarter. Home improvement retailers Home Depot and Lowe's, they also struck cautious tones in their results. Home Depot CFO told investors on its earnings call that its full-year outlook was impacted by, quote, some benefits from hurricanes that won't fully repeat in 2025, and that it assumes continued pressure on larger projects. Lowe's outcome fell below Wall Street's expectations as well, highlighting more cautious consumer spending in the year ahead, too. This brings us to our second point. Promotions are still key to luring in consumers. Target saw gross margins fall about 0.4 percentage points in its fourth quarter, partially due to, quote, higher promotional and clearance markdown rates. Now, the heavy promotion environment is something that we haven't just been seeing in retailers. We've also been seeing it in the adjacent restaurant industry as companies like McDonald's, Wendy's, and Yum Brands are using promotions like these meal deals, these $5 meal deals, to really lure in consumers and battle for the few dollars that they're willing to spend here. And that brings us to our last point. Tariffs. Retailers are beginning to sound the alarm of what this could mean for its consumers. Target CEO said as far as vegetables and fruits go, the consumer will likely see price increases over the next couple of days. Best Buy also chiming in. CEO Corey Berry telling Yahoo Finance around 55% of its products are sourced from China in some way, shape, or form, and another 20% comes from Mexico. She told Yahoo Finance, quote, "We expect much more impact in quarters 2 through 4 versus this first quarter in terms of increased prices." Now, of course, keep in mind that this is a very agile situation and retailers are following this really, really closely. They're ultimately having to make these changes very quickly, despite months and months of getting ready and getting prepared of what this could look like.
And as we've been talking about this morning, Brooke, the policy is shifting so quickly. It's challenging for us as journalists to keep up with it, and of course for companies to kind of chase the wheel as well. So we appreciate you covering it for us and breaking it all down. Well, auto stocks are rising after Commerce Secretary Howard Lutnick says some auto companies may be exempt from tariffs. Lutnick telling Bloomberg companies that are in compliance with the U.S.-Mexico-Canada trade agreement could receive exemptions, which could be announced as early as Wednesday. On Tuesday night, President Trump told members of Congress that tariffs could be good for the auto industry.
And by the way, we're going to have growth in the auto industry like nobody's ever seen. Plants are opening up all over the place. Deals are being made. Never seen. That's a combination of the election win and tariffs. It's a beautiful word, isn't it? That, along with our other policies, will allow our auto industry to absolutely boom. It's going to boom.
For more on this, we turn to Matt Deegan, senior editor with Kelley Blue Book. And Matt, obviously it's been challenging to track the huge swings that we've seen from these tariffs. We had stocks in the auto space selling off the back of these tariff announcements yesterday. And then today you have Howard Lutnick saying, well, maybe car companies will get a carve out. How does that impact the end consumer? If these automakers do get carve outs, then no price raises for cars for consumers?
Yeah, well, uncertainty certainly is kind of the word of the day here. There's just so much in flux that we don't know. If these tariffs end up not affecting autos, then that's going to be a huge bullet that they dodge. Because if they do go into effect, or if they, as intended, go into effect for the car industry, we're talking, that could raise the price of your car thousands of dollars. Mm-hmm. So this could be a really big hit for consumers who are shopping for a car right now.
And we've already seen used car prices ticking up, Matt. I wonder, do you think there's any evidence of both used car dealers, but also dealers in general, maybe seizing the tariff opportunity as a moment where they can get away with raising prices because consumers are primed for it due to tariffs?
Well, that's always a concern. And the issue is we're already flirting with record high prices for both new and used cars. I mean, the average transaction price of a new car these days is nearly $50,000. And it's about half of that for a used car. So if you haven't shopped for a car for a while, and most people don't, this isn't something you buy every year. It just seems that there's constant sticker shock is what we're hearing from consumers who are out, getting ready to buy a car. They're thinking, is that truck really $50,000, $60,000? And the reality is, yes, it is. Now, if these tariffs are implemented, that could raise those prices by $3,000 to $10,000 on the average new car.
And when might those price hikes take place? If consumers are listening right now, would it benefit them to run out and buy a car today before those price hikes hit?
That's a great question. And normally we're not one to say, you need to go and buy your car right now. But if you are in a position where you've done your research, you know the blue book value of the car that you should be paying, all your, you've dotted all your I's and crossed your T's. If you are ready to buy a car right now, you probably want to jump on that sooner versus later. And the reason is because the cars that are on dealer lots right now or in transit to dealers, they will not be affected by the tariffs. It only affects, if they do in effect happen, they affect cars being imported to the US from these neighbor countries.
Yeah.
So if a car is already on a dealer lot, well, the price is the price. It's not going to be affected by tariffs. So if you are ready to buy a car right now, you probably want to jump on that sooner versus later.
And it's interesting too, just given what you said, that we were already at such record highs when it comes to auto prices. Do you think there's a risk of consumers falling off a cliff and just saying, okay, well, we just can't afford these prices anymore? And what impact might that have on automakers?
Yeah, and that's already happening to some extent, because when they see the new car prices, they say, I can't afford this.
Yeah.
So guess what? They go to the used car lot, and then that in turn puts pressure on used cars. And again, we just see these prices going up and up. So it's not an easy time to be shopping for a car, or frankly anything else right now. And interest rates still are, higher. So that puts more pressure on just how much people are paying to afford the cars.
Matt, really quick, what is the best way for consumers to find an affordable car right now?
Well, again, you might want to go used, you might want to go certified pre-owned, or you might want to look at some brands that will have a lot more inventory. We're talking brands, brands like Nissan, Mazda, Buick, Dodge. All of those brands have higher levels of inventory. They're going to be more willing to deal than, let's say, your Toyota, Lexus, or Honda dealer, which has tight supply right now, and you're probably not going to find a really good deal on one of those cars.
All right, Matt, great breakdown. Thank you so much for joining us. Coming up, we'll continue our conversation around tariffs and how they could impact your wallet. We'll discuss the housing market next. Let's get a quick check on your market action here. You've got stocks still under pressure today following several days of losses here. If you take a look at the S&P 500 over the last couple of days to kick off the week, you can see that we're in the longest losing streak so far that we have had since December. We have stocks still under pressure following the announcement of those tariffs from the Trump administration. We actually did see a little bit of a lift to stocks earlier in the trade. You can see that it's been a pretty volatile session, dipping between the green and the red here. We had that ISM services data coming in better than expected, indicating maybe a little bit of a recovery in the market. That's when you saw stocks lifting. We also had commentary from Howard Lutnick indicating that there could be some exemptions and carve-outs on tariffs. So you saw a bit of a lift to stocks then. But now also we have that ADP report indicating some weakness in the labor market. That's also potentially weighing on stocks just a bit. You've also got your small caps continuing to be under pressure. And if you take a look at small caps since election day, you can see that they have dropped 15% from that November high following the election of President Trump. That made investors think that we were going to see a little bit of a come down on things like interest rates. That's usually a lift to small caps, but as you can see, those stocks still under pressure this morning. Well, home builder stocks are rebounding today after Commerce Secretary Howard Lutnick hinted that President Trump could offer some exemptions on tariffs. Investors likely hoping for carve-outs for the lumber industry. We heard from Jim Tobin, the CEO of the National Association of Home Builders, about the potential impact.
We get 30% of our lumber from Canada, and that will certainly crimp our ability to build more houses, but build those houses affordably. Everything is starting to impact, again, tariffs and immigration policy are really starting to squeeze every market in this country.
Joining me now on this, Logan Mohtashami, a lead analyst at Housing Wire. Logan, great to speak with you. How are you seeing tariffs potentially impacting home prices?
I don't think the builders have the margins to really push prices too much higher right now. With rates elevated, I think their concern is, they're not going to be building a lot of homes. And it's different. When COVID happened, lumber prices were $1,000 higher than where they are today, but mortgage rates were at 3%. So the increase we've seen in lumber prices already in the last few weeks is anticipating tariffs and duties and what traditionally we deal with lumber pricing. But the builders' active inventory is up, completed units are up. The South is a problem for them. So I don't see them really pushing the prices too much on the consumer now. But I do see this as, they're not going to be building a lot of permits with rates elevated right now. And this just hampers the future production of housing in this kind of environment. This is one of the reasons why the White House wants lower mortgage rates as well.
So then that's interesting. Where do you see home prices going in the near term versus long term?
Now, the existing home sales market, if tariffs and the economy slows down, we reduce spending, we fire people, 10-year yield goes lower, that helps pricing, right? It's really rare in America post-World War II for nominal home prices to fall, but we do see pricing softness when rates are elevated. So to me, it's more of a rate story for the existing home sales market. For the builders, it's a supply and margin story right now. And they were not happy about anything talking about tariffs. And this is why if you look at the Builders Confidence Index, the last 2 months has had one of the biggest drops in looking out forward 6 months. And you could see this higher rates and tariffs does not help them build a lot of homes in the future.
So if you are looking for a home right now and you've been hoping for interest rates to come down to make it more affordable, should you go ahead and buy as soon as possible?
I mean, but if you're looking for a house right now and you've done the pre-qualification, then you're pretty much legit where you're looking to buy, whether rates are up a quarter or down a quarter. But if the economy gets weaker, right? If tariffs actually bring the economy growth slower, then bond yields can go down and mortgage rates go down. I think this is one of the reasons why the White House and Treasury Secretary Bassett, they are very, very active on trying to get mortgage rates lower because it alleviates some of the concern of tariffs and higher costs out there. But in this case, mortgage rates have been hovering back and forth for a few years now. Yeah. It's really rare to even get under 6% since 2022. So you're dealing with a housing market that's very unaffordable. And the builders are also very stressed right now with rates elevated. And on top of this, the tariffs coming in, it just hurts their margin ability.
Yeah, and we haven't even talked about the potential impact of immigration policy, but I want to talk about first-time homebuyers in particular, because one of the challenges, as you know, is that there isn't enough supply of those single-family, smaller homes for starter first-time homebuyers. What's your outlook for those smaller homes? Do you anticipate more of that supply coming into the market?
I always ask everyone, what does an affordable house look like? Like really, like it's really, it has to be a condo or a townhouse, but then that marketplace is getting hit with insurance costs and right. HOA costs are rising. So the supply of the condo market is actually faster than the single family market. So you're not getting any relief there, but because they are smaller than single families, they tend to be priced much lower. So if you're looking in that kind of starter home, townhome, condo, the difficulty is the HOAs are increasing. So you're not getting much relief in the total payment there as well.
Is the ROI there on a townhouse, a condo, is that return there for people who see it as an opportunity to have an investment in a property where they're not throwing away rent every month and they can sell it someday?
You know, housing is a cost of shelter to your own capacity to own the debt. I think traditionally home buyers tend to make more money than renters. So you have millions of people buying homes each year. But the HOA condo market is much different now than it in the previous years, especially we see the stress in Florida. Can you get insurance? Can the condo project even get approved? Can you even get a mortgage? Some people have a very hard time selling their homes to anybody with a mortgage buyer. So there is stress in that marketplace. But for the kind of the first-time home buyer that doesn't make a lot of money, that would be one avenue to deal with housing inflation. But again, the HOA costs increasing makes that a little bit more affordable than it has in the past few years.
Yeah. All right, Logan, great breakdown as always. Thanks so much for joining us.
My pleasure.
Coming up, the former head of the Social Security Administration has a warning about layoffs and missing payments. Plus, tax season is underway. Some of you watching may qualify for relief if you were impacted by a natural disaster. We'll explain more after the break. Could your Social Security payments be at risk? That is what the former head of the Social Security Administration is warning, saying the agency could be at risk of missing payments to seniors for the first time in its history, thanks to staffing cuts planned by the Trump administration. Here with more, we've got Yahoo Finance senior reporter Jordan Weissman. Hey, Jordan.
Hey, thanks for having me.
So talk to us about what these potential payment misses could look like and could mean for consumers.
So Social Security has never missed a payment, and as long to retirees as long as the program has existed. Here's what O'Malley is worried about. At the moment, the Social Security Administration is looking to cut its workforce by about 12%, from 57,000 to 50,000 workers, right? What O'Malley says is that this is probably going to lead to a massive brain drain of all the tech support people who know how to maintain Social Security's payment system and know what to do if something goes wrong. And the reason for that is that a lot of those guys are really, really old. Social Security runs on a language called COBOL. It's this ancient computer code that most younger IT people don't know how to deal with. So much of the IT support of Social Security is already at retirement age, and they're now being offered all these buyout and early retirement incentives. So he's worried that they're simply not going to have the staff on hand to intervene if something goes wrong with the systems, with their old mainframes, and payments suddenly stop. And he thinks it's very likely that this is going to happen. I've also talked to the chief information officer, or former chief information officer, who resigned in January. She's also sounding the warning about this.
So Jordan, obviously it would be politically extremely damaging if there was a miss to Social Security payments. Just curious what your sources are telling you more broadly about how likely that miss might be.
So apparently people are divided within the Social Security Administration. And there are some tech guys there who think, no, this isn't likely to happen. Once your name is in the system, payments are just designed to go out automatically, and that will keep running come hell or high water. O'Malley and some others are not so sure. And the reason for that is that they've just never really tried to run Social Security on such a bare bones staff, or at least such a bare bones staff as the Trump administration appears to be planning for. So it's not a guarantee, but what O'Malley has been telling me and other reporters is that if he were a retiree, he would be putting aside some money right now.
All right, Jordan, really great roundup. Thank you so much for joining us. We appreciate it.
Thanks for having me.
If you were impacted by a natural disaster last year, you might qualify for some tax relief. 2024 had 27 natural disasters costing $1 billion or more, responsible for $183 billion in damages and impacting millions of Americans, some of whom could qualify for those tax deductions. Here with what you need to know before you file, we've got Mark Stieber, Jackson Hewitt's Tax Service Chief Tax Officer. Mark, great to have you on. I want to start on what to do. What can people who've been impacted by these natural disasters do to get some relief?
First, and I'm from Florida, so believe me, I'm all too personally affected by this, and I have followed this for decades as I came from other hurricane states. The first thing is not to put a priority over your family's safety and security. Taxes are important, and they're certainly something you can't get away from, but it's not the most important thing. So once you got your house and your life in order and your family secured, do not look past the tax rules. There's a lot of crazy rules and loopholes in the law. Some of the best rules for American taxpayers, especially those disaster affected, are in the natural disaster, especially the federal declared disaster rules. There are delays in time, of course. You've seen those extensions to file, and those are great. They give you time not to worry, but there are more benefits in carrying your losses, especially if you've suffered economic loss, back and recovering back taxes, offsetting current taxes, even carrying the losses forward, calculating the losses. People panic because they don't have good records, they don't have basis. There's a lot of latitude in that as well. Any good tax pro can make you get the best result you can if you've otherwise been adversely affected. But do not put off the focus on your family, and secondly, do not put off looking at the tax benefits in the horrendously complicated tax code for some of those really, really important nuggets that can get you back on right track economically.
And help me out here. Do you have to itemize your deductions in order to benefit from some of that disaster-related relief, or can you take the standard deduction and still get some of that relief?
Well, and it's really, really complicated. I won't bore your viewers with it. I'll simply say you can take a deduction if it's a federal disaster area if you itemize, but the reality is you usually have a federal disaster, you get quickly there much faster than you would with just a normal year. So you do need to itemize, and there's some other, thresholds that you have, but the reality is if you lost a house or a property or even damage or even yard debris, or whatever it might be, you can get past those pretty minimum standard deductions, $14,000 if you're single pretty quickly, $24,000 if you're married. That sounds like a lot, but $24,000 of damage, I had that last year without even losing a home, just with damage to my property, pool, cage, cars. When you get a big hurricane, and you know it when you see it, or wildfires, let's be clear on those California people, or earthquakes, or just the list goes on and on. I think there's like a dozen states right now. Get a pro, help them understand what your damages were, let them help you understand what else you need, video, documented footage as fast as you can get it on the damage, because the loss is really the value before and the value after, subject to the basis and the rest. But the point is that it's not just the extension of time. That may sound like a really nice benefit, and it is, and not having to pay taxes or file later, but those losses that you can carry back immediately and get a fast backwards refund can help you jumpstart your economic situation.
And you said you don't necessarily have to have the note keeping and bookkeeping perfectly in order to
That is the one big myth. Oh, I don't have the basis for my house and car and yard work and trees. No, they let contemporaneous documentation substitute. Now, you do have to have more than just a bar napkin with some notes, but a good pro can help you go, well, when did you buy it? When do you have a picture of it? What was the value at that point? You can get an appraiser. There's lots of tools, lots of FEMA resources, and lots of help in this space because so many people are affected. And it is one of those good things in the tax code amidst all the other bad news that you might have. Oh, it's complicated. I hate taxes. If you've been disaster impacted, economically impacted, I promise you there's some salvage in there.
And really quickly here, you said that not everyone who's been impacted by a natural disaster can get this relief. You have to be in a specific area.
You have to be in a federally declared disaster area. That was some of the new law put in several years ago. And what is that? Well, that's when it's bad, and you know it. Not you had a lot of rain or you had some flooding. You know, those may be, but it has to be declared by FEMA. It has to be declared by the president, a federal disaster area. Now, the bar is pretty low, and you know it when you see it. Big hurricane, for example, big rainstorm, all the fire areas. And you can go to the FEMA website or the IRS website, put in your zip code, it'll tell you whether you're in a federal disaster area. But I can tell you, being from Florida, you know it when you see it.
Yeah, well, and it's interesting too, just really quickly, should these individuals still be trying to get their taxes in as soon as possible?
Well, the carry back loss as soon as possible, because that's money in hand. That's not money that you paid this year. That is taxes. And last year, you can carry a federal disaster loss backwards. And you say, well, I can't get the exact number. There's some latitude on that. You carry as big a number back as you can accurately forecast, and then you refine it with an amended return. There's lots of different ways to get where you need to be. And so it's not a file fast like it is for regular taxpayers to get your refund and get your tax return prepared. It's more of a help you economically by just doing what the law allows, carrying a disaster loss backwards and recovering your prior year taxes. It's a really nice tax benefit in the tax code.
All right, well, we appreciate you breaking that down for our viewers, Mark. Thank you so much for joining us. Really appreciate it. Let's do a final check on the markets here. You've got losses still occurring across those major averages. You've actually got them taking a bigger step lower this morning. We had the S&P 500 and the tech-heavy NASDAQ waffling around the flat line, but you see them taking a step lower here. You've got the S&P off nearly 0.5%. Your tech-heavy NASDAQ down just about 0.5% as well. And it's interesting, we're actually seeing energy and utilities leading the losses for the S&P 500 today. Utilities falling to their lowest levels since January here, which is interesting off the back of utilities as an AI play. And then you've got energy down nearly 3% in today's trade. You've got leadership in materials and industrials and healthcare potentially off the back of those ISM numbers. All right, that's going to be it for Wealth. I am Madison Mills. Thank you so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton. That's at 3 p.m. Eastern.